Hello, my name is Mike Carrazzo. I'm the content manager here at Ryerson. We do a little thing every month, a Thursday, first Thursday of every month called Cup of Joe. But in between Cup of Joe, we sometimes need a little shot of espresso. So what we with some hot topics that come up. And right now, the topic of the rising price of oil is a really hot topic, and we thought it needed its own segment. So, as we record this, the price of crude oil barrels $113. The price to fill up gas here in Illinois is approaching $5. It's on everybody's mind. So we thought it might be best to bring in someone who knows a lot about this market, Kevin Beery. Kevin, welcome to the very first shot of Espresso Joe. Kind of rolls off the tongue, doesn't it?
Yeah, good morning, Mike. Definitely happy to be here. As you know, down here in Texas, we're happy to be the guinea pigs for anything Ryerson is doing. So I was definitely happy when you guys asked me to come on and talk a little bit about this. I don't know if I'm necessarily an expert, but I know enough to be, dangerous, at least provide a little context for our customers. So my name is Kevin Beery. Currently, I'm the general manager of sales for the Ryerson, Texas multi-market based out in Houston. Been with Ryerson for just over 9 years. And prior to that, I worked for one of our suppliers, Timken Steel, who was heavily tied to the oil and gas market. Prior to my current role as the general manager of sales for Ryerson, Texas, I was our market manager for the oil and gas market for all of Ryerson. So I kind of been in and out of the oil patch since I moved down to Houston in 2009, through at least now 2 cycles, maybe 3 cycles if you count 2020 with the pandemic as the 3rd cycle I've been through here. And now we're kind of back to this crazy rising price of oil we have.
Well, yeah, absolutely. And certainly there's so much going on. And, we thought it'd be best to kind of frame this up with, there's a lot of assumptions out there, right? Hey, price of oil is going up, just drill more. This is all the current administration's fault. Well, no, let's dig into some of those and kind of get the reality. So that's kind of the format we're going to go with. So let's get right into it here with the first assumption, if you will. So a lot of saying, hey, all what's going on, this is the current administration is entirely to blame for high gas prices. So let's kind of debunk that a little bit, if you will.
Yeah, and the goal here today is to use as much facts, as much knowledge-based resources we have. I mean, everybody's seen the stickers a lot of people are putting on gas pumps with Joe Biden pointing up and saying, "I did that," which is not necessarily 100% the truth. While the current administration definitely has done a couple of things that weren't helpful for the oil and gas industry and not helpful for the price of oil, the fact remains that oil itself, there's tons of different indices, a lot of different grades of oil across the world, but the fact remains that it's a globally traded commodity and it gets traded across the world. So we have two charts here. The first is the WTI price of crude oil, which is typically the main U.S. index, just because it's a light sweet crude, what is typically produced out of West Texas, North Dakota, even into the Rocky Mountains. This is kind of the price of oil that a lot of people in the U.S. look at, right? So you can see we've seen this is the only oil that went down to negative $40 per barrel at one point during the pandemic. But then all of a sudden it shot back up, and it's kind of was hovering in that $50 to $75 range for a while. And just over the past couple of weeks, really shot back over to $100 a barrel. And kind of what's happening there, you can see the second chart that I have there below is actually this price spread between WTI and Brent crude. Brent crude is kind of the European rest of the world benchmark for oil pricing, and the WTI is kind of the U.S. Price benchmark. So the rising price of oil is not just a U.S. phenomenon; it's something that's happening around the world, and something that's really kind of a global market where it gets traded back and forth. I'm going to talk a little bit about the production side of this later on in the presentation here, but a lot of this relates back to the production and kind of what happened with the shale boom that happened in 2011 to 2014, and kind of what the U.S. did as a producer of oil back in those times. So while the current administration may have reduced federal leases and cut them off completely, took out the Keystone Pipeline, while those have been major effects in the oil industry, right now, as of 2019, federal lease rates and federal leases only accounted for 23 to 24% of total oil production across the United States. With that being said, 77 to 78% of the total oil production across the United States came from private land. So while there were no new federal leases coming on board, it only accounted for 23 to 24% of the total oil production to begin with. So it should not have had that major of an effect on what's happening in the marketplace today. So the bigger story, in my opinion, is what's happening with natural gas. So if we jump to the next slide here. So natural gas is actually, in my opinion, for the rest of the world, not necessarily for the United States, kind of the bigger story of what's going on in the oil market. So the oil price is kind of a global commodity, gets traded across the world. Natural gas, on the other hand, is very regionalized. The two biggest producers of natural gas in the world are the United States and Russia. And well, what's gone on in the past 3 to 4 months with Russia, and they pipe all their natural gas directly into Europe through the Nord 1 and Nord Stream 2 pipelines that go into Germany. You can see on the left side here, we have the natural gas price in the United States. You can see at the beginning of 2021, middle of 2021, it started to peak, and it typically peaks with the cool season in the United States, and then kind of falls back during the summer and then peaks again for natural production, right? A lot of natural gas in the United States is used for heating homes, and also another good portion of it is used for commercial energy production, and then commercial product production through steel mills, aluminum mills, all the different types of metal producing and goods producing companies that use natural gas. Now, if you look at the Europe price, which is traded through the Dutch trading, which is in the Netherlands there, because all the natural gas from most of Europe runs through there, you can see 2021, they've been hovering typically in that $20 range for most of the last 5 years. It didn't have a lot of effects. There wasn't a lot of seasonality like you saw in the United States, just because they were getting abundant supply. Then all of a sudden, at the end of 2021, there started to be a couple tensions with Russia. There started to have a little shortage on production out of Russia. And people are talking more about canceling the Nord 2 pipeline, which really happened in December, January is when people really started talking about reducing the volume of gas flowing through the sanctions. And then all of a sudden, last fall, we started seeing some of our producers of aluminum in Europe shut down for days because the price of gas was too high to produce products, right? Which caused the price of aluminum to spike back in January. You can see here in 2022, there's been extreme volatility. And at certain points, the price of natural gas in Europe was 10 times what they were paying for it last summer, which takes the cost to produce any goods that are using natural gas, aluminum, plastics, fuel oils, heating oil, anything like that, has made it almost cost prohibitive in a lot of cases. So while oil has been expensive, natural gas in Europe has almost gone up 10x and on average 5x in price of where it's averaged for the last 5 years.
So Kevin, that's the primary energy source used to produce metal, correct?
I would say natural gas and power are the two primary energy sources. Natural gas just because they can get the metal so hot, and then power because a lot of electric arc furnaces use power to melt scrap metal into actual refined steel. And also on the aluminum side, the smelting of aluminum is very power and natural gas intensive.
Gotcha. Okay.
So, how did we get to all these rising prices? So one of the things that we've looked at, and I've looked at this chart since probably about 2010 when I really got into the oil and gas industry here. And this is tracked by the U.S. Energy Information Administration. They kind of take a look and provide almost every quarter, they provide a short-term energy outlook for the U.S. and kind of what's going on in the market. And they have this great chart that shows world production of oil and natural gas versus the forecasted consumption or the world consumption of it. And you can see, 2017, 2018, when the oil market was pretty hot, we saw there was pretty good consumption. Consumption was actually outweighing the production there for a good part of 2017. All of a sudden, the U.S. turned down a lot of production in 2018 from the shale producers out in West Texas, North Dakota, up into Oklahoma. And all of a sudden the world production goes a little bit higher than where the world consumption is. Kind of stayed that way for most of 2018, some into 2019. Then all of a sudden at the beginning of 2020, we see, the first wave of COVID hit. World travel gets cut off. People aren't driving as much. Airplanes aren't flying as much. all of a sudden you see world consumption and demand for oil just fall off a cliff in comparison to what's been happening for the last 10 to 15 years. So with that happening, all of a sudden, hey, world production needs to adjust. And for most of 2020, we were actually well below on the consumption side. So there was a huge buildup of inventories. And then all of a sudden, hey, 2021 comes around, the world starts getting back to normal in some cases. At least while we're managing through the pandemic, a lot of the domestic and international production starts happening again. People start traveling just a little bit more. Demand starts building. But what happens is production typically, depending on where you're doing it, we'll talk about the US here in a minute, but across the world, production typically can't catch up to demand nearly as fast as it can rise, at least is what we saw. So we saw in 2021, you saw some minorly rising oil prices there in 2021. But once you really saw this demand really start to hit and get back to close to normal, that 100 million barrels per day, that's when we saw the price of oil start to take off. And obviously the most recent price of oil shooting at over $100 a barrel was due to the conflict between Ukraine and Russia, just because Russia is the third largest producer of oil in the world. So you can see forecast at some point here in 2022 and Q2, it is projected that we do get back to producing more oil than is demanded, which should in effect balance that price of oil and start to push it down at some point, depending on what happens with Russia and Ukraine.
Great. Thanks for that overview. I think it's really kind of gives a view of really what is going on with these different commodities. So back here in the States, hear this a lot. Everyone talks about, can we quickly fix this issue by drilling more here in the United States?
That's always been the assumption. The oil and gas slogan for as long as I've been here, it's been, drill, baby, drill. Let's put some more holes in the ground. Let's get that out. And, back in, the 1980s, 1990s, it's pretty simple. You could pop one hole in the ground. It's pretty quick to get it back to production. Today, it might be a little bit more complicated. You've got to track a couple different factors. So if we jump to the next slide here. So the first thing we look at is the rig count. Every week, Baker Hughes publishes a weekly rig count of how many rigs are working in the United States, on land, offshore, just kind of shows activity of new wells being drilled. The second thing that I look at typically every week is what's our drilled but uncompleted wells. We call these DUCs. This is a well that has been drilled, but isn't ready to produce because we haven't done all the completion activities, such as hydraulic fracturing, putting a capping stack on it, putting a surface wellhead on it, and getting it into a production system. That's the second thing we track. And then the third thing we track is the frac spread number. And that's how many frac crews are out there working in the US. We've seen all of these. We've seen the rig count go up this year. We've seen the frac spread crew rate go up this year, down from the rig count was down near 100 at one point during the pandemic. It's back up into the 350 to 400 range, but not nearly back to where it was before this all happened. Same thing with frac spread count. We've seen that increase over the past couple of months, but it's kind of getting to a point where it's being limited by several factors that we're really trying to understand right now. So I'd say if you are trying to hire people in any industry, it could be any industry. It could be restaurant services. It could be somebody to run one of our welding machines over at our Texas Steel Processing facility. It could be just a general laborer to pull sheets. It is hard to find people right now. That same exact thing is happening for the oil patch. Right now, I've talked to a couple people to find a day laborer, just somebody who can go out there, huck iron around, make connections pretty quickly, not a lot of skill involved in that labor. They're paying about double what they were in 2019 for those day labor guys just to go out on frac spread crews. Same thing is said for drill rigs. And so the labor is a big problem. The second big problem these guys are facing is availability of parts for both drilling and completions. Both of those activities are very metal and very goods intensive. So what happened in 2020, and it happens in every single downturn, is the oil and gas companies, the production companies are saying, hey, listen, we got to drill a new well. We can go buy a new tool, or hey, I've got an idle tool sitting over here. Let's take the idle tool, put it into service, and all of a sudden, hey, we've got it. We solved our problems without spending any more money, right? So all of that's been done. And so at some point, probably I'd say about September of last year is when we really started to see demand come back for a lot of those tools, a lot of those parts that they'd not been using over the past year and a half. And all of a sudden, they're like, hey, we need to start building these. And that happened at a time when the supply of a lot of the products, forgings, long products, bar, heavy plate that goes into making those parts starting to get extremely constrained. For example, like one of our steel mills who makes long products that go heavily into oil and gas industry, during 2021, they quote you 6 to 8 week lead time for material. Now they're quoting 20 to 22 week lead times for the same material. So it's made getting back up to speed a huge challenge for a lot of these companies. The one thing that a lot of people talked about heavily was, hey, can we just complete some ducts? And we've seen the duct count fall from around 8,000 in the middle of 2020, and right now it's right around 4,500. So we've seen that fall by almost half. And at this point, if there's a drilled but uncompleted well out there, the likelihood of it being a good viable well is pretty low. So now we have to, and we're forced to go and drill more wells. But as we said, labor is constraint, materials constraint, parts are constraint, just like we're seeing constraints across the supply chain in almost every industry right now.
So if I'm hearing right, okay, so you have these drilled but uncompleted wells. We've tapped into a lot of those based on demand, right? So in order to drill more, we need to invest in the equipment, but just like everything, hard to produce the metal, supply chain issues. So just it's kind of a supply and demand of the material at this point for these things.
Oh yeah, it all ties back to supply and demand, and we have way more demand than supply in almost everything right now. If you jump over the next slide, unlocking the U.S. production is not as simple as it used to be. Obviously, there's factors when we came back in 2017, and you can see I have the chart of U.S. oil production. And in 2011 is when I really started looking at this, and basically from the end of the 1980s up through 2011, the U.S. always produced somewhere between 5 and 6 million barrels of oil per day. That was our average production. We weren't going to go too high above that. We weren't going to go too much below that just because we had it. And then all of a sudden, one of the big major technological breakthroughs that happened is back in about 2010, hydraulic fracturing was determined that, hey, we can do this at such a rate now, it becomes a cost-effective manner for us to go out and produce hydraulically fractured shale wells, right? So you can see in 2011, from 2011 to 2015, when the first oil crash hit there in the 2010s, you can see we almost doubled our production. We were producing almost 10 million barrels per day. The oil market crash of 2015-16 took us back to that 8.5 million barrels per day. Then all of a sudden, 2017 hits, demand's good again. And you can see we crushed production from 8.5 million barrels per day all the way up to 13 million barrels per day at the beginning of 2020. So when we had that increase there, we didn't have a problem getting metal, right? We didn't have a problem getting labor. We didn't have a problem getting almost every commodity out there. So we could increase production pretty quickly in that time. But you can see it's still only 1.5 million to 2 million barrels a day per year that we could increase. So it's not an immediate overnight kind of thing. And you can see middle of 2020, we fell down to about 11 million barrels per day. There are some weeks where, you shut off your wells or there's a freeze or a natural disaster where we fell lower than that. For the most part, we've still built up and we're steadily producing about 11.6 to 11.8 million barrels per day on average every single week here in the U.S. Getting ahead of that and getting up is going to require, more manpower, more metal, a lot of the things we don't have. So it's not something we just turn on overnight with the capital and manpower intensity of producing these shale wells.
So I guess to go back real quick, if we could, right now we could drill more. It's a matter of labor, resources to bring that up to speed, correct?
Yep, that's correct.
Great. Okay, so now let's get into another assumption here. Talked about, high price of gas right now. I talked about, here in Illinois approaching $5 a gallon. I'm sure it's that everywhere. I don't know where it is by you, Kevin, but we all kind of feel that pain at the pump. So the assumption is this all relates back to the high price of oil. That may not necessarily be the case, right?
Yeah, I mean, while oil is definitely the driving cost factor, the largest cost factor of producing a gallon of gas, it's not necessarily the only driving factor of producing a gallon of gas, right? So you can see crude oil accounts for probably 50 to 60% of the cost of gas or diesel. Refining accounts for another portion of it, distribution, marketing, and then taxes. Taxes is something that really have no control over. That's either federal or state, depends on where you live. Obviously, states like Illinois, New York, California have higher taxes. States like Texas, Louisiana, Arkansas have lower taxes. For the most part, the three things that we focus on when we're talking about the price of oil is obviously the crude oil, right? Because that is the driving factor of the cost of a gallon of gas. And then the two things there are refining and distribution and marketing. Refining is the process of taking that oil, refining it to a gasoline that can be used in your car. And so that process is heavily labor intensive. It goes through a lot of refineries here in the Gulf Coast region where they're faced with rising costs on almost everything, right? They have to maintain those facilities. Those facilities use a lot of high value metals, high stainless steels, nickel alloys. And as we've seen in the market over the past 2 years, the price of those precious metals and the high value items is much higher. I mean, the average price of stainless a year and a half ago was $1.50 a pound. Now it's over $4 a pound on average. So you can see the cost to refine oil is going up just because of the cost of everything that go into it. The stainless steel to make it, the labor of the people who are refining it. It all ties back to everything else that we're seeing here. The other thing there is distribution and marketing. That is, how much it costs for certain people that work for the refineries and oil companies to negotiate contracts with their gas stations, what the cost of transport is. While most oil and natural gas and gasoline is all transported via pipelines, the last couple of miles for most places is transported by trucks. And as you can see, with the price of diesel going over $4 a gallon in February, the price to transport it and distribute the oil and natural gas and gasoline keeps going up. So yeah, while crude oil is the driving factor, there are other factors that we're seeing across almost every industry that do drive the price of gasoline going higher. So it's not as simple as saying, hey, we need to get the price of oil down, we need to drill more, we need to figure out how to make this cheaper. We still are going to have constraints across the board, whether it be from metals, whether it be from labor, whether it be from transportation costs that are still affecting the rising price of oil and gasoline in effect.
This is an interesting graphic, Kevin, and really looking at what goes into a cost of a gallon. And I don't want to say I was surprised, but I didn't realize less percentage of crude oil goes into diesel. I thought it was a little bit more, and even the refining is a little bit more too. It's a very eye-opening. And like you said, I mean, it comes down to the crude oil, but I mean, if you look at labor costs going up and the cost to produce things, that's definitely going to continue to make this price source. It's an eye-opening graphic for me, and I'm sure for our viewers too. Yeah,
and our goal here today was to debunk some of those myths, maybe provide a little bit of education to everybody, so that when you're faced with that higher price at the pump, kind of what goes into getting that there.
So Kevin, thank you for debunking these myths, if you will. What would be the one or two key takeaways viewers should take from this?
I mean, the key takeaways I have here is, we're going to continue to see some high prices on oil here short term, which means you're going to be paying maybe a little bit more at the pump. It all ties back to every other factor we've seen. It's not just one thing causing this, right? It's kind of the combination of factors from what's going on with coming out of a global pandemic, the shortage of labor across the board for all these different industries, the rising cost of almost every good you have there, and then just general inflation. So I just want everybody to know it's not just one factor, there's multiple factors, and it requires, kind of working together to figure out long-term how we can solve this for everyone.
What would be a data point? Everyone looks at the price of crude oil, right, on a daily basis. And I even opened up with, the price, but as we've learned, there's much more into it than that. So somebody that kind of wants to keep tracking this, what are some resources you would point them to track?
the best way to track the two things that I look at all the time, I look at the price of oil, and then I look at the EIA data. Every month they publish a short-term report on kind of what's going on in the market, and kind of gives these breakdowns monthly of, hey, what's going on with gasoline, what's going on with diesel, what's going on with natural gas. The EIA.gov is a great resource if you have questions about it.
Perfect. Well, Kevin, thank you for taking the time educating myself, the viewers, and this has been very enlightening and a good conversation to have. A reminder, we do Cup of Joe, our commodities update, the first Thursday of every month. And as topics like this come up, we will do these special shot of espresso updates. So Kevin, thank you for your time.
No problem. Thank you for having me.